After retiring from the federal government or uniformed services, you have several options to withdraw money from your TSP account. One option is converting all or a portion of your funds to an annuity. The annuity option is likely the least understood withdrawal method because the TSP annuity has various features that many people don't know about. And in general, people have mixed feelings about annuities. With that said, this video isn't meant to promote or criticize the TSP annuity. Instead, I want to clearly explain how the TSP annuity works. I'll cover the available annuity options, how you receive your payments, the different beneficiary features, and how the money is taxed. But before we dive into all those important details, welcome to the Money Briefing. My name is Jerrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. The TSP annuity is an optional way to withdraw money from your TSP account. And this form of annuity differs from the first annuity and any pension payments that you may receive from the federal government or military. If you choose the annuity option, the TSP will use your money to buy an annuity from an outside provider. Currently, MetLife is the only annuity provider for the TSP, and they held that role since the TSP started in 1986. Before purchasing an annuity, it's very important to understand how it works, because once you purchase the annuity, that money is no longer part of your TSP account, and you can't change or cancel the purchase. In its most basic form, the TSP annuity is a trade-off where you essentially give up control of your money in exchange for monthly payments that are guaranteed for your life and potentially the life of a survivor. But before you give up that control, you do have some say in how the money will be paid out. Your monthly payment amount depends on several factors, such as your age when you buy the annuity, the amount of TSP funds that you use, the interest rate index at the time of purchase, and any extra features that you add to the annuity. The TSP annuity is often called a life annuity because it's based on a person's life. You have the option to get the TSP annuity as a single life annuity or a joint life annuity. With the single life option, monthly payments are only based on your life, whereas the joint life annuity is tied to you and one other person. In most cases, the joint annuitant is the person's spouse, but you can choose a person that has an insurable interest in you, like a former spouse, a child, or a sibling, as long as that person is financially dependent on you. With the joint life option, monthly payments will continue as long as one person is alive, but the amount will vary based on whether you choose a 100% or 50% survivor benefit. If you select the 100% survivor annuity, the monthly payment amount stays the same for the survivor as when you both were alive. But with the 50% survivor annuity, the monthly payment amount for the survivor, whether that's you or your joint annuitant, gets cut in half from what you received when both of you were alive. It's also worth noting that if you name a joint annuitant other than your spouse who is more than 10 years younger than you, then you must choose the joint life annuity with the 50% survivor benefit. Apart from selecting a single life or joint life annuity, you can also decide whether you prefer level payments or increasing payments. Level payments remain the same year after year. On the other hand, increasing payments start out smaller, but the payments grow by 2% each year on the anniversary date of your first payment. With level payments, inflation will gradually reduce your purchasing power over time. However, if you choose increasing payments, your monthly payments will be lower in the early years of your retirement when your spending is generally higher, but you'll only lose purchasing power in years that inflation exceeds 2%. The increasing payment feature can only be combined with either the single life annuity or the joint life annuity with a spouse. Furthermore, the TSP annuity offers two key features that may impact your beneficiaries. One is the cash refund feature, and the other is the 10-year certain feature. With the cash refund feature, if you or your joint annuitant pass away before receiving the full amount used to purchase your annuity, The remaining balance will be paid to your beneficiaries in one lump sum. For example, if you buy a single life annuity for $100,000, and if you die after receiving only $80,000 in payments, your beneficiary will receive a $20,000 lump sum payment. The 10-year certain feature ensures that if you die before receiving annuity payments for 10 years, payments will continue to your beneficiary for the remaining 10-year period. However, if you live beyond 10 years, you'll continue receiving payments, but no further payments will go to your beneficiary after your passing. If you don't pick one of these two options, MetLife will automatically keep any money left in your annuity. As I've mentioned earlier, all these features will affect your monthly payment. Generally, the more features that you add, the lower your monthly payment will be. Taxes can also impact your payment. For annuities purchased with traditional TSP money, payments are taxed as ordinary income. Distributions from your Roth contributions are tax-free, while Roth earnings are also tax-free if they meet the qualification rules. It's also important to note that annuity payments are exempt from early withdrawal penalties, regardless of age. So, if you're considering an annuity, you can initiate the process by logging into your account on the TSP website. You must invest at least $3,500, and this minimum applies separately to the traditional and Roth balance. Once all the necessary information and documentation are received, your annuity request will generally be processed and dispersed within 5 business days, and your monthly payments will begin approximately 1 month after the annuity is purchased. After the funds are dispersed, remember that you cannot cancel the annuity, change your joint annuitant, or modify any added features. The only things that you can basically update are your beneficiaries and your banking information. In the event that you need to make changes to these things, or if you have general questions about your annuity, you should direct those questions to MetLife, since they are responsible for distributing your payments. When researching the TSP annuity, you should definitely utilize the TSP Annuity Calculator on the Thrift Savings Plan website. The calculator allows you to run various scenarios to see how different combinations will affect your monthly payments. I also recommend that you review the current interest rate index on the TSP website. The interest rate is tied to the 10-year U.S. Treasury securities, so the rate may adjust monthly. I've included a link to the TSP Annuity Calculator and historical annuity rates in the show description. As part of your due diligence, you should also evaluate how other third-party annuities compare to the TSP annuity and weigh the other TSP withdrawal methods, like the installment plan, against the annuity option. Looking at different options both inside and outside of the TSP will help you make the most informed decision about your TSP withdrawal strategy. If you received any value from this video, please hit the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please check out our website at www.fedwayfinancial.com. Thank you for watching, and we'll see you on the next Money Briefing.